Hey everybody, and welcome back to Business Tube. So this final Business Tube podcast for Section 5, we are looking at the analysis of the business's financial accounts. So there's two things we're going to look at. We're going to look at ratio analysis, okay, and we're going to look at profitability margins. So first of all, we will be looking at the profitability ratios, okay, and there are three of these margins that we are going to look at. We're going to look at the gross profit margin, net profit margin, and ROCE, okay, which stands for return on capital employed, okay. So there's three that you need to know, and these are three formulas. And I'm afraid, guys, because in business studies you don't get given a formula sheet in the exam. So although I have made a formula sheet for you, you don't get given a formula sheet in the exam. You just simply have to learn these formulas. So stick them on post-it notes, put them around your room, put them around your house, give them to your parents, get tested on them, but you must learn these formulas. Now, the first margin that we're going to look at, so the gross profit margin, okay, we basically take our gross profit, we divide by turnover. Remember, what is turnover? That's sales revenue, so that's the money coming into the business, our income, times it by 100, okay? What does this show then? Okay, well, basically, this shows how much gross profit have we got from our turnover, because we're doing gross profit divided by turnover, okay? Let's have a little look at an example. Okay, so here, gross profit is 360. So remember the formula for gross profit? We had to take turnover, aka sales revenue. Sales revenue is 900 minus cost of sales, which is 540. Just a quick recap again, what is cost of sales? The cost of sales are basically the raw materials. So these are the variable costs for the business. So in here we have a gross profit of 360. Now what we can do is we can put this into our gross profit margin formula. So we take gross profit, which is 360, we divide it by turnover, which is 900, and we times it by 100. That gives a gross profit margin of 40%. So remember, the gross profit margin is gross profit, which is 360, divided by turnover, which is 900, times 100, and that gives us a gross profit margin of 40%. Now let me go over what that means. Now, 40%, is that good or bad? Do we want a high percentage or do we want a low percentage? Well, think about it like this, okay? The higher the percentage, the better. Because in an ideal situation, if we have turnover of 900, what is the perfect situation here? Well, the perfect situation would be cost of sales of 0. So if we have no costs, we have 900 coming in, we do 900 minus 0 gives us a gross profit of 900. Now if we put that into our formula, okay, 900 divided by 900 times 100, that would give us a gross profit margin of 100%. What does that mean? Well, that basically means that our gross profit is 100% of our turnover, of our revenue. Basically, that means that our cost of sales are low. So the higher the percentage, the lower the costs. Okay? In order to have a higher percentage, that must be a bigger percentage, gross profit must be a bigger percentage of turnover. So it's good to have a higher percentage. If the percentage goes up, that is a good thing. It means we're more efficient, it means our costs are lower. So a higher gross profit margin is better. Okay? Let's have a look at the next one, net profit margin. Now, the formula is the same as gross profit margin, but this time we don't divide by gross profit, because it's the net profit margin. So this time we divide by net profit. So this time it's net profit divided by turnover, aka sales revenue, times 100, okay? And again, we want a higher percentage, because the higher the percentage, the more net profit we get to keep or get to have from our turnover. Let's have another look at a worked example. Okay, we've got sales revenue of 900 minus cost of sales of 540, which gives us a gross profit of 360. Then we have our expenses, operating expenses of 270. So 360 minus 270 gives us a net profit of 90. Okay? Now we can calculate our net profit margin. We do 90 divided by 900 Okay, because remember the net profit margin formula is net profit divided by turnover times 100. 90 divided by 900 times 100 would be 10%. So let's have a little look. So again, we want a higher percentage. The higher that percentage, the more net profit we have from our revenue. Okay, again, the ideal situation would be that we have costs of 0. If our cost of 0, we have no cost whatsoever, okay, then we would have a net profit of 900. 900 divided by 900 times 100 would give us a net profit margin of 100%. So again, what do these margins show? They basically show efficiency. The lower your costs, the higher the profit, either net profit or gross profit. And the higher that is, as a percentage of revenue, the higher the margin. So a higher margin shows that the business is more efficient and it's getting its costs down. Okay, that's what these margins show. Okay? Okay, next up we have ROCE. Now, if you think back to the last podcast when we looked at balance sheets, what is capital employed? Capital employed, remember, is the long-term finance invested in the business. So it's where the business is getting its money from, whether that be owner's savings, share capital from selling shares, reserves, or a loan. Okay, a long-term loan. So capital employed is where is the business getting its money from. So what is ROCE? ROCE stands for return on capital employed. Basically, how much profit have we made from the money that we have invested? Okay? How much profit are we getting from what we've invested? So the formula for ROCE is net profit divided by capital employed times 100. Let's have another look at a worked example here. Okay, we have a capital employed of £1,800 and we have a net profit of 90. So basically we've made £90 profit from the money we've invested, which is 1,800. If we think back to the formula, what do we do here? We take our net profit, we divide it by the capital employed, and we times it by 100. In this example, net profit is 90, divided by 1,800 times 100 gives us a ROCE of 5%. What does that mean? That means we've made a profit of 5% on what we have invested. Again, do we want a low percentage or a high percentage? The higher the percentage, the more profit we are making on what we have invested. So for ROCE, again, a higher percentage is good. The higher the percentage, the better. Okay? Because the higher the percentage, the more profit that we're making from the money that we've invested. If we look at another example, if that was £180, we would do 180 divided by 1,800 times 100, and that would obviously be 10%. So the higher the net profit, then the higher the return on capital employed will be. Okay, let's have a look at liquidity ratios now then. So first of all, just a quick recap, what is liquidity? Liquidity is the availability of cash. Remember, it's the lifeblood. It's the blood flowing through the money. Cash is the money flowing through the business, okay? So we need cash in our business. If we don't have cash, we cannot pay our bills, we cannot pay our salaries, we can't pay our workers, our suppliers, and we are finished. Even if we're a profitable company, we must not run out of cash. Okay? Just because you have cash in your business doesn't mean you can go and buy a machine. Because a machine, remember, is a fixed asset. It's very difficult to turn that back into cash. And if we run out of cash, then we cannot pay people. So just because you're profitable doesn't mean you won't fail. Because we've got to have cash in our business. Okay? So what is liquidity? Liquidity looks at a business's ability to pay its debts. Okay? Its current liabilities, its short-term debts. Okay? The faster an asset can be turned into cash, the more liquid that asset is, and that's what we call a current asset. Okay, let's quickly go through this slide then. So liquidity, remember, it's the ability of a business in order to pay its debts. Okay? Liquid assets are those that can be turned into cash quickly. Okay? And all businesses need to think about, do we have enough cash in order to pay our short-term debts? And what are the short-term debts called? They're called current liabilities. So can we pay people if they all come knocking and asking for their money back? Can we pay people? Can we give them their money back? Current assets, liquid assets, remember, they are assets that we plan on keeping for less than 12 months. And the key thing to remember is current assets or liquid assets that are easy to turn into cash. Okay? Debtors, remember, debtors are people that owe the business money. Again, how do I remember? They are in your debt. They owe you. And the word that they will use on your course, they will call them trade receivables. Trade receivables. Okay? Stock can be turned into cash. However, remember, stock is the least current of current assets, because in order to turn stock into cash, we have to sell it cheaply, and we don't want to do that. Okay, the first one that we look at is the current ratio. Now, in order to calculate the current ratio, we do current assets divided by current liabilities. Nice and easy. Current assets divided by current liabilities. What are current assets? Current assets are things that you own that can be turned into cash quickly. What are current liabilities? Remember, liabilities, you owe it. They are people that you have to pay back very, very soon. So we just divide current assets by our current liabilities. Okay, let me just go over this last thing here then. When we look at the results on the next page of a worked example, the ratio, we want the minimum ratio to be 1.5 to 1 and the maximum to be 2 to 1. Okay, so let's have a look at what that means. Okay, this business has got current assets of 35 and it has current liabilities of 15. So in order to get the current ratio, we do current assets of 35 divided by 15, which gives a ratio of 2.3 to 1. What does that mean? Now remember, a ratio means how much of this do you have for every one of these. Basically, for every one current liability, how many current assets do we have? Okay, so we've made this into its simplest way. So for every one current liability, we have 2.3 current assets. Okay, if we look at that there, we have 15 current liabilities, we have 35 current assets. So for every one current liability, we have 2.3 current assets. Now, is that a good ratio? Is that a good current ratio? Absolutely not. This is too high. The maximum we want the current ratio to be is 2 to 1. Okay, so this business is either holding too much stock, too many debtors, or too much cash. Okay. We don't want the ratio to be too low. We don't want it to be too high. Okay. Remember, the minimum is 1.5 to 1 and the maximum 2 to 1. Okay. One last thing. Just remember, what is this showing? This is showing, is the business able to pay its current liabilities? If they all came knocking, everybody we owe money to, if they came knocking and asked for that money, can we pay them? Well, yes, we can, because for every one person that we owe money to, we have 2.3 in current assets to pay them. So this business is liquid. It has enough current assets to be able to pay the people that they owe money to. Okay, a better test of liquidity is the acid test ratio. Now, the reason why the acid test ratio is a better test of liquidity is because we exclude stock. Remember, if people come knocking on your door asking for their money back, we don't want to have to sell our stock to be able to pay them back. Because remember, if we have to sell stock, we've got to lower the price in order to pay people back. And we don't want to have to lower the price. So with acid test ratio, we exclude stock, and then we look at, can we pay our current liabilities? So the acid test ratio, we do current assets minus the stock divided by current liabilities. This time, the ratio needs to be between 1 to 1 and a maximum of 1.5 to 1. So no less than 1 to 1 and no higher than 1.5 to 1. Okay? If it's less than 1 to 1, we don't have enough current assets to pay our current liabilities. And if it's higher than 1.5 to 1, then we've got too much cash and too much debtors just sat around doing nothing. And if we've got cash and if we've got people owing us money, get the money back and invest it. So equally, we don't want it to be too low and we don't want it to be too high. This is kind of the Goldilocks zone, let's say. It's not too hot, it's not too cold. Okay, it's not too low, it's not too high. Okay, if it's too low, then we have liquidity problems. We don't have enough current assets to pay our current liabilities. And if it's too high, we've got cash sat around in the bank doing nothing. And if we've got cash doing nothing, we should use it and we should invest it. Okay, again, why do we exclude stock? Remember, stock takes a long time to turn into cash. Stock is the least liquid of current assets. And if we want to get rid of stock to pay our debts, if we need to get rid of stock to pay our debts, then we've got to reduce the price. We've got to sell that stock off cheap, but we don't want to have to sell stock off cheap. Okay, so we don't want to use stock to be able to pay our current liabilities back, which is why with the acid test ratio, we exclude stock. Let's have a look at another example of this then. So we've got our current assets of 35 and our current liabilities of 15. But remember, with the acid test ratio, we need to remove stock. So 35 minus 20 gives us 15. 15 divided by 15 would give us an acid test ratio of 1 to 1. Okay? Now last year, this business had an acid test ratio of 0.8 to 1. So here, this is too low, because remember, the minimum is 1 to 1. So this was too low, and now it's 1 to 1. So things have improved. It was too low here, it's just okay. 1 to 1 is okay. So for every one current liability that the business owes, it has one in current asset without having to sell its stock to pay them. Okay, so it has enough debtors and enough cash to pay its creditors. Okay, we can see that there. Debtors and cash equals 15, and we can pay our creditors because we've got 15 of these for every 15 of these. Okay, so that gives us a 1 to 1 ratio. We can pay people back if they come asking for their money. The last one that you need is the gearing ratio. Now, the gearing ratio basically shows how the business is financed. Okay, if you think back to the balance sheet, remember on the balance sheet, the capital employed, we don't want most of our money coming from a loan, because remember, a loan is debt, it has to be repaid. So we don't want most of our money coming from a loan. So in order to get the gearing ratio, we take our long-term liabilities. Remember, what are the long-term liabilities? They are the loans. So we take any loans that we have in our capital employed, and we divide it by capital employed. Okay? Times it by 100. So this business has got a loan of 50, and its capital employed is 100. So of all the money that this business is financed by, 50 divided by 100 times 100, of all of the money that this business is financed by, of all of its capital employed, 50% of it is coming from a loan. 50% of this business's money has to be repaid. So that is a very, very bad gearing ratio. With this one, we want a lower percentage. The ideal situation is that we don't have any loans. No loans. We don't owe any money. So that would be 0. 0 divided by 100 times 100 would give us a gearing ratio of 0%. Okay? So we want this to be lower. The lower this percentage, the less loans the business has. So remember, long-term liabilities, which are the loans, divided by capital employed times 100. Okay, boys and girls, that is the final podcast for section 5 on finance. I hope you found it useful. Please share and like these podcasts if you found them good, and I'll see you next time.